You know, when the market takes a dip like it has recently, it's easy to get caught up in the headlines and start hitting that panic button. But today we're going to take a deep breath and dive into the analysis of Tom Lee. He's a financial analyst who's making a pretty compelling case for why this might actually be a market bottom.
Yeah, that's right. Tom Lee has a history of going against the grain and correctly calling market turns, and what he's seeing now is fascinating.
So fill us in, what exactly is Tom Lee's take on the current market situation?
Well, he believes that the recent drop we've seen, especially in tech stocks, is a classic case of the market overreacting. He's pointing to companies like Nvidia, Palantir, and Tesla, all down 20 to 40% despite posting strong earnings and having solid future prospects.
Okay, so he's seeing a disconnect between what the market is doing and what the fundamentals of these companies are actually showing. But what's driving this overreaction according to Lee?
He identifies a couple of key factors. One is what he calls rage selling, essentially a wave of panic selling fueled by fear. Think of it like this. You're in a crowded theater and someone yells fire, even if there's no real fire. Everyone rushes for the exits, creating a chaotic stampede. That's what's happening in the market right now.
So it's not necessarily that these companies are doing poorly, but rather this fear-driven selling that's pushing prices down. And what's the other factor Lee points to?
He's also highlighting the impact of trade tensions and tariffs. These are legitimate concerns, of course, but Lee argues that the market is overestimating their potential negative impact, leading to a disproportionate reaction.
That's interesting. So we have this fear-driven selling combined with an exaggerated response to trade tensions. But how does Lee support his claim that this is a market bottom? Is he just going with his gut here?
Not at all. He's actually backing it up with some pretty compelling historical data. He looked back at every instance since 1950 where the market dropped 10% in less than 20 days, and in each case, with one exception, a significant rebound followed.
Wait, hold on. What was the exception?
The exception was the COVID-19 crash, but even that was followed by one of the biggest market rallies ever.
Ah, okay, that makes sense. So historically speaking, when we see these rapid drops, they tend to be followed by a pretty strong bounce back. But let's be honest, relying solely on historical trends can be a bit risky, right? What other evidence does Leo use to support his thesis?
Well, one thing he points to is the speed at which these drops are happening in the past. Information traveled much slower, so market reactions were more gradual today. With high-frequency trading and instant news dissemination, the market can swing wildly in a matter of hours. This means that these rapid drops are more likely to be driven by short-term panic rather than fundamental changes in the economy.
That's a really interesting point. So while history shows us that these sharp declines are often followed by rebounds, the speed at which they're happening today suggests that they might be even more likely to be temporary blips on the radar. This is all very intriguing.
It is, and it raises an important question if Tom Lee is right, and this is indeed a market bottom. What opportunities might that present for investors?
Ooh, that's where it gets exciting. But let's save that discussion for part 2 of this deep dive. I'm already hooked and can't wait to hear more. All right, so we've established that Tom Lee believes we're at a market bottom, and he's got some compelling arguments based on historical trends and the speed of these recent drops. But what does this mean for investors? Should we all be rushing out to buy stocks right now?
That's the million-dollar question, isn't it? And while I can't give financial advice, what I can do is walk you through Lee's thinking on what this potential market bottom could mean for investors.
Perfect. Let's do that.
One of Lee's key points is that market downturns often create opportunities to buy into great companies at a discount. He uses a quote from legendary investor Peter Lynch: "The stock market is the only place people run from a sale."
That's such a great analogy. Everyone loves a sale when it comes to clothes or electronics. But when it comes to the stock market, we tend to run for the hills.
Exactly, and that's where discipline and a long-term perspective come in. Lee argues that those who can overcome their fear and recognize these downturns as potential buying opportunities are the ones who tend to come out ahead in the long run.
So it's all about resisting that urge to panic sell and instead looking for potential value plays. But how do we identify those value plays? Does Lee give specific guidance on that?
He does remember those companies we discussed earlier, Nvidia, Palantir, and Tesla. Lee believes that these companies, despite their recent price drops, are actually undervalued by a market.
Okay, so he's not just saying buy everything. He's specifically pointing to certain companies that he believes have strong long-term potential. What makes him so confident in these companies, though?
Let's start with Nvidia. They're the dominant player in the graphics processing unit market, and those GPUs are essential not just for gaming, but also for artificial intelligence data centers and self-driving cars. These are all massive growth areas, and Nvidia is at the forefront of it all.
That makes sense. They're definitely a company with their fingers in a lot of important pies. What about Palantir? They're a bit more under the radar, aren't they?
They are, but they're doing some incredibly innovative work in data analytics. They're primarily focused on government and intelligence agencies, helping them make sense of vast amounts of data to improve decision making and national security. And they're also expanding into the commercial sector using their data analytics capabilities to help businesses optimize operations and gain insights from their data.
So they're kind of like the data whisperers, helping organizations extract valuable information from what would otherwise be just a jumble of numbers. And then there's Tesla, which needs no introduction, I guess.
Right. Tesla is already a household name leading the charge in the electric vehicle revolution. They're not just making electric cars, though they're also developing advanced battery technologies, solar energy solutions, and even self-driving capabilities.
So these companies are all leaders in their respective fields, and they're all tackling huge growing markets. That's starting to paint a picture of why Lee sees them as potential value plays in this downturn. But I'm also curious, are there any risks associated with these companies that investors should be aware of? It can't all be sunshine and roses, can it?
You're absolutely right. No investment is without risk, and it's crucial to acknowledge that. For example, with NVIDIA, one risk is competition. There are other players in the GPU space, and new technologies could emerge that disrupt their dominance. For Palantir, their reliance on government contracts could be a vulnerability. Changes in government priorities or budget cuts could impact their revenue. And with Tesla, while their growth has been impressive, they've also faced challenges with production delays, profitability, and regulatory hurdles.
So there are definitely risks to consider, and it's important for investors to weigh those risks against the potential rewards, it sounds like. What Lee is suggesting is not to blindly buy into these companies, but rather to do your due diligence, understand their businesses, and carefully consider whether they align with your investment goals and risk tolerance.
Exactly. It's about informed decision making, not just jumping on a bandwagon.
That's really helpful insight. But before we move on, I want to go back to something you mentioned earlier, the importance of a long-term perspective. Can you elaborate on that a bit more? Why is it so crucial, especially in times like these?
That's a great question, and it's something that Tom Lee emphasizes throughout his analysis. You see, the stock market is inherently volatile in the short term. Prices can fluctuate wildly day to day or even hour to hour, but over the long term, the market tends to trend upwards.
Right, we talked about those historical trends earlier.
Exactly. So if you have a long-term investment horizon, say 5, 10, or even 20 years, these short-term fluctuations become less significant. What matters more is the overall trajectory of the market and the underlying strength of the companies you're invested in.
So it's about not getting spooked by the daily ups and downs, and instead focusing on the bigger picture.
Precisely, think of it like sailing a ship. If you're focused on every little wave that comes along, you'll get seasick and lose your course. But if you keep your eyes on the horizon and your destination, you'll weather those waves and eventually reach your goal.
I love that analogy. It's a great reminder that investing is a marathon, not a sprint. But it's also easy to get caught up in the short-term noise, especially when the market is as turbulent as it is right now. What advice would you give to investors who are feeling anxious and unsure of what to do?
Well, the first piece of advice would be to take a deep breath and try to detach yourself from the emotional roller coaster of the market. Remember, fear and greed are powerful emotions, and they can cloud your judgment instead of reacting impulsively. Take some time to step back and reassess your investment goals and risk tolerance.
So it's about taking a moment to center yourself and make sure your actions are aligned with your long-term plan, not just your current emotions.
Exactly. And the second piece of advice would be to focus on what you can control. You can't control the market, but you can control your own actions. You can choose to stay informed, do your research, and make informed decisions based on your individual circumstances.
That's really empowering. It's about taking ownership of your financial journey, even amidst the chaos. This has been incredibly insightful.
I'm glad you're finding it helpful. And remember, even though we've been talking about Tom Lee's analysis, it's crucial to do your own research and form your own conclusions.
Absolutely. Tom Lee's perspective is valuable, but it's just one perspective. It's important to consider other viewpoints, analyze the data yourself, and ultimately make decisions that you're comfortable with.
Couldn't have said it better myself.
Seems like we've covered a lot of ground here in part two. We've talked about Tom Lee's belief in the opportunities presented by this potential market bottom. We've delved into his analysis of specific companies like NVIDIA, Palantir, and Tesla, and we've emphasized the importance of a long-term perspective and informed decision-making. I'm eager to see what other insights we can uncover in part three.
Me too. There's always more to learn, and I'm sure we'll have plenty more to discuss.
You know, it's funny how we often talk about the stock market, as if it's this rational, predictable entity. But when you really dig into it, you realize just how much psychology plays a role. We've talked about rage selling, but I'm curious, are there other psychological traps that investors often fall into, especially during times of market volatility?
Absolutely. One that comes to mind is something called anchoring bias. It's the tendency to fixate on a particular price point, usually the price at which you bought a stock.
Okay.
So if a stock drops significantly from that anchor price, even if the underlying company is still performing well, we tend to view it as a loss and become more likely to sell, even if it's not the most rational decision.
So we're essentially letting our emotions dictate our actions rather than looking at the objective facts. We're holding on to that initial price point as if it's some sort of magical number, even though it might no longer reflect the true value of the company.
Exactly. And it's not just about losses.
Yeah.
Either anchoring bias can also work in reverse. If a stock goes up significantly from our anchor price, we might be hesitant to sell because we're anchored to that initial price and feel like we're leaving money on the table.
That makes sense. It's almost like we're afraid to let go of that initial point of reference, even if it's no longer serving us. So how do we overcome these psychological biases? How do we become more rational, more objective investors?
Well, one key is awareness. Simply recognizing that these biases exist and that we're all susceptible to them is a good first step.
Right. It's like shining a light on those hidden thought patterns that might be influencing our decisions.
Precisely. And once we're aware of these biases, we can start to develop strategies for mitigating them, for example, when it comes to anchoring bias. One strategy is to focus on the fundamentals of the company rather than just the stock price. Ask yourself, is this company still performing well? Are they growing? Do they have a strong competitive position? If the answer is yes, then a drop in stock price might actually present a buying opportunity even if it's below your anchor price.
So it's about shifting our focus from the price ticker to the actual business behind the stock. It's about looking beyond those emotional triggers and making decisions based on a rational assessment of the company's prospects.
Exactly. And it's not always easy, especially when the market is volatile and emotions are running high. But remember, investing is a long game. Those who can stay disciplined, stay informed, and make rational decisions are the ones who tend to come out ahead in the long run.
That's a powerful message to end on. So as we wrap up this deep dive into Tom Lee's market analysis, I want to thank you for sharing your insights and expertise. I know I've learned a lot, and I'm sure our listeners have as well. Any final thoughts you want to leave our listeners with?
Yeah, I think the biggest takeaway here is that while market downturns can be scary, they can also present unique opportunities. Those who can keep a cool head and approach these situations with a long-term perspective can potentially benefit from the market's tendency to overreact in the short term. Just remember to always do your own research and make sure any investment decisions align with your own individual goals and risk tolerance.
Couldn't have said it better myself to our listeners.
Ah,
Thank you for joining us on this deep dive. We've explored Tom Lee's perspective on the current market situation, delved into his analysis of specific companies, and most importantly, highlighted the crucial role of psychology in investing. Remember, knowledge is power, and the more we understand about market dynamics and our own biases, the better equipped we are to navigate the ups and downs of the financial world. Until next time, happy investing.